Hello to everyone. Today I am here with Introduction to Corporate Finance Part 1. In order to grasp the concept of the topic, please do watch my video till end. And secondly, if you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover what is corporate finance, the financial statement balance sheet, the balance sheet of the firm and the capital budgeting decision, capital structure and goal of firms. What is corporate finance? Corporate finance need to address in three key areas. First of all, investment decision. What long-term investment the firm should engage in? Definitely, long-term investment is normally against the capital expenditure, mean types of tangible and non-tangible assets. Finance decision, how long the firm raised the money to meet the financial obligation against the capital generating from long-term investment. Definitely, the long-term investment decisions are met with the financial mix of capital equity and capital debt. So on one side, you have required to fulfill the wants of equity holders. And on the other side, you will have to meet the financial obligation against the money you have borrowed that invested in the capital expenditure. Dividend decision, firm priority to pay the dividend and its proportion to the profit. Equity holders want dividend. So you have to set how much proportion of the profit will be distributed as dividend to the shareholders. The financial statement, first of all, in this video, we are a bit concerned about the balance sheet only. The easiest way of summarize a firm is its balance sheet. What a firm owns in the shape of assets. What a firm owes, its liability. And the difference of assets and liability equal to equity. That is the part related with the owners of the company. Asset and liabilities can be classified as current, having a life less than 1 year, and non-current, having a life longer than 1 year. So it's the segregation of asset and liabilities related to a firm. The net working capital requirement of a firm is the difference between the current assets and current liabilities. We also called it as short-term requirement because of having the life less than a year. Normally, this requirement comes against to meet the production need, and on the other side, to meet the running finance need. That is also called day-to-day expenditure. Positive net working capital represent good health of the firm. If it's negative, you will have to meet that requirement. If it's positive, it means you are able to meet your short-term liability against your assets. In order to having the more clarity, we used to calculate the quick ratio because quick ratio is net of the inventory. The part of the inventories we have to kept aside in order to meet our production need. Balance sheet model of the firm. the total firm value of the asset. That includes current asset and fixed asset. Fixed assets are in the shape of tangible and intangible. There are other variables too. On the other side, the total firm's value to the investors in the shape of current liability, long-term debt, and shareholders' equity. So the difference between the current asset and current liability equal to net working capital. It's an other model, the capital budgeting decision. Current asset, fixed asset, tangible, intangible. Current liabilities, long-term debt, and shareholders' equity. Now, the capital budgeting decision is related with the fixed asset. What long-term investment the firm should engage in? Which type of assets the company requires? In the shape of like machinery, equipment, furniture, fixture, vehicles, etc. These are the types of tangible. Tangible also include immovable assets like land and building. Whereas intangible is related with the goodwill, any lessons, software. These are the requirements. So, the business have to decide that which type of the investments the business concern or the firm should engage in. Thereafter, and other important point arises, how can the firm raise the money to meet the financial obligation? Definitely, you have borrowed the money. On one side, the equity holders inject the money. Equity holders also having the expectation of a certain level of return. On the other side, the part of debt the company or the firm has borrowed have to meet against the financial obligation. Financial obligations are met against the profitability generated by the firms. Either the firm is able to generate this much profitability to meet the financial obligation or not. It is very important to calculate before engaging into the business. Any adverse decision may lead towards business failure. Capital structure. A firm's capital structure is a financial mix of capital equity and capital debt maintained by the firm. So, a capital structure should be designed very smartly, keeping in view to have the ability to meet the financial obligation against the debt and to what level the company can enjoy maximum level of tax benefit. So tax benefit calculation is also very important before developing the financial mix against the total capital employed injected within the business. Decision need to be made on the financial mix, how and from where the money raised, keep in view the optimal slice up a pie. It's also very important. Equity is no doubt in it, owner's money. But on the other side, a business cannot survive without having or cannot grow without having the part of capital debt. So pi is the structure. At maximum to one extent, the capital debt should be inducted within the business. Some companies prefer 30 to 70%. It may be more than, that part can be more than 70%, provided it is utilized properly and against the revenue generating assets. If it's inducted in a proper way against the revenue generating asset, those assets will add the profit to the organization. Second thing, either the incremental cash flows are generating profit more than the cost of capital debt. If it is so, definitely those assets are adding additional profit to the business. The role of financial manager is to make smart investment and financing decisions. Thank you very much. See you again with the upcoming video on the same topic very soon.